Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the Equity Mates community. My name is Bryce, and today, as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. A big show. We are covering a community question. We're talking about dividend reinvestment plans. And what a timely time to talk about it, because most of the major Aussie ETFs have paid their dividends this week. So everyone is hopefully feeling a little flush. We've got another episode of Pimp My Portfolio. Luke Laretive is joining us for that. But first of all, there's heaps making news. So let's get stuck into it.
News and markets.
Nice. Well, big news, Ren. We've completed our live show down in Melbourne. So I just want to give a massive shout out to everyone that came on the night. It was an epic show. If you didn't make it, the good news is it was all recorded and we will be releasing it in due time. But we just want to say a huge thank you to everyone that did come and support us. Full house. We had people standing, and it was just a great evening. So thank you to the audience, and then also our experts, Luke and Dylan, and all of the others, Phil and everyone that was in the audience and supporting the night and answering all the questions throughout. We're looking forward to many more across the next 12 months.
Yes, it was great. But look, the news of the moment is all about the Aussie stock market, at least the finance and investing news of the moment. There is plenty making news outside of that world, which we're not going to touch on. So let's focus on the Aussie share market, because it is hitting all-time highs.
It is. So the ASX 200 has surpassed 8,000 points for the first time ever. Now, we don't necessarily track the points here too closely, but it is a milestone. First time that it's hit 8,000 points. The big drivers for this, though, Ren, the big four banks.
Yeah.
Absolutely smashing it.
Who's complaining about banks and miners now? Well, the miners, not so good. BHP down like 15% for the year. Rio down like 21% for the year. But how about these banks? So this is year to date. Combank up 17%, NAB up 21%, ANZ up 15%, Westpac up 22%, and I've included Macquarie here as well, because they're essentially pushing into the big four territory. Macquarie up 11%.
So absolutely killing it. Being dragged. So the index itself is then probably being dragged down by the industrials, the miners and co.
Yep.
Year to date, the ASX is up just shy of 5% at the time of recording.
Did I say Rio down 21%?
I can't remember.
I think I did. BHP's down 14% year to date. Rio down 12%. Fortescue down 24%.
Wow, there you go.
Yeah. So we're hitting all-time highs.
Yes, CBA back in the number one position.
Yeah, they knocked BHP out of the top spot.
Yes.
And I think this is just another reminder of the importance of staying invested, because there would have been plenty of reasons to sell the banks. In fact, earlier this year, Macquarie downgraded all four of the major banks, and Citi put out a sell all four major banks in like April. But they've just kept on keeping on since then. So I think it's a reminder to sort of just kill the noise, keep investing, stay invested over the long term. Your ability to time the market is not zero, but it's nearing on zero. Even the best with all of their information can't do it. And for all of the reasons that the Aussie stock market shouldn't be doing as well as it is, for all of the reasons that the Aussie economy is struggling, we're hitting record highs.
Yeah.
We've never been this high.
Love to see it.
Yeah.
Love to see it.
I've got a few other companies that are worth just mentioning quickly.
Okay.
So big divergence in the two supermarkets. Woolworths down 8% for the year.
Time to buy.
Coles up 8% for the year.
Well, we know what happened to Woolworths. That's not as bad as they were, though. I think they were down over 10% at one point. So everyone's seeing value in Australia's leading supermarket, being Woolworths. Not a buy, hold, or sell. But yeah, that is interesting to see.
And then two more that I think are worth pointing out. West Farmers up 22% for the year.
Yeah. Bunnings.
They do own Bunnings.
Yes. Yeah. What else?
They own Officeworks, Kmart, Target,
Yeah.
and they have an industrials business as well.
Fascinating, given the pressures that a lot of consumers are coming under.
Yeah.
So,
I actually don't know what part of the group is driving that performance. Maybe it's Bunnings. But if it is Kmart and Target, you could see consumers trading down into... Yeah. But if we're doing a roundup of the large cap Aussie stocks driving the index, we have to touch on this one. It's in the top 10 and it is just ripping. It's Goodman Group. Up 42% year to date. The property developer and owner is riding the rise of data centers, amongst other things, to new highs.
Yeah, so if you held the VAP ASX, the Vanguard Australian Property Securities Index, you would be benefiting from that because it is a large position in that index. So yeah, interesting. So we spoke about CBA knocking off BHP, and there is some news that is surrounding BHP, Ren, that shows the perils of thematic investing. The headline is that BHP is stopping a lot of its nickel operations in Western Australia, specifically Nickel West and a West Musgrave project. They said they're going to temporarily be suspending these. Until something like 2027.
Yeah,
or something
Feb
like
2027, they'll revisit the decision.
So that's the headline, but help us understand why this is a good reminder on the challenges when it comes to thematic investing.
The last few years, one of the biggest thematic investing themes has been battery metals. And there's a bunch of ETFs that have spun out in Australia, the US, everywhere to invest in that theme.
ACDC.
Yeah,
Is the
and
Globex one.
yeah, there's a heap. So let's not name check them because it's unfair to the ones that we don't name check. There's a heap.
Yeah.
And the overall thesis is right. Nickel is one of the critical battery metals. Lithium is another critical battery metal. And the demand for those metals, amongst others, is going to massively grow. And that's the thesis for the thematic ETF, and that is completely true. But just because demand is going to grow doesn't necessarily mean that every producer is going to do well and every country with those metals is going to do well. Because just because demand grows doesn't mean price will grow. And this nickel story is a classic example of that. The reason that... So Australia and Indonesia have equal first for supply of nickel. We are going to be... in theory, going to be nickel powerhouses. The problem is that Indonesia can produce nickel a lot cheaper than us. And so this global oversupply is coming from Indonesia and a little bit from China. But because Indonesia is producing it so much cheaper, BHP can't compete. So in Australia, for all of its reserves, can't compete. And it means that BHP, if you were going to invest in BHP with a thesis around battery metals and nickel, you were right that they can produce a lot of nickel. It's just that the global price has moved against them and they're not going to be able to do it cost competitively.
Yeah.
And I think you can see that in history with a number of other materials. I think the classic example was that Scott Phillips actually spoke about on an episode of Buy or Sell. He was speaking about it in context of lithium, which also demand is rising, but price is absolutely tanked because there's cheaper supply coming on. Supply is growing faster than demand. And he spoke about the same thing happened with oil back in the day, like 100 years ago. Everyone had this thesis that oil demand was going to massively increase, and it did, but price didn't move in that same way because new technology came on and new supply came on that meant we could produce it a lot cheaper. So it's a watch out when you're investing in a thematic ETF for that reason.
Thematic ETF, but I think specifically in all those examples where it's a commodity-driven...
That's a great observation.
Commodity-driven ETF. Yeah. Where truly supply and demand is just the driving factor.
Yeah. Because the price is a two-sided equation, and a lot of the thesis is really just focused on one side of that equation, which is demand. Yeah.
Love it. Well, let's keep moving.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Your
Question answered.
If you would like to submit a question, head to equitymates.com/contact, just like Tommy did. So this question from Tommy: Hey guys, question regarding dividend reinvestment plans. When the dividend is insufficient to buy another unit of a share or ETF, the money appears to be untouchable until it reaches that threshold. Other than investment fees, it seems to me like it would be better to not have a dividend reinvestment plan, claim the additional interest when it's in the bank, and then invest in ETFs of my choice. Where do we stand on this? So,
let's do it.
Let's do it.
Well, I think before we get into where we stand, let's do Dividend Reinvestment Plans 101. So what is it? As the name suggests, it's a plan that allows you to reinvest your dividends.
Explain DRP without saying DRP.
So essentially, let's say you own BHP.
Yeah.
They pay a healthy dividend. You can take that dividend in cash, or you can ask BHP to reinvest that in more BHP shares. Now, there are a number of reasons why people like to do it. The main one is it's like truly set and forget, reinvest without me having to worry about it. It's important to stress that there is no tax benefit. You still pay tax on the dividends either way. But yeah, it's automatic. It boosts your returns. It's cost efficient, I guess, in the sense that there's no brokerage fees. So that's good. Mm-hmm. So there are some reasons why people really like it.
Yeah. You get out of your own way. You can kind of DCA into it. I think something to keep in mind is what Tommy did say, that it only happens if you have the adequate amount to reinvest back in. So if BHP pays you a dividend of $20, but the share is 25, you'll need to wait until the next quarter when it pays, or whatever frequency it is, to actually buy a stock. And so then in that instance, that $20 sits in your share registry, waiting for the next round to come along.
And what happens if you sell the shares and there's like a money left over in the registry?
So it depends is the short answer. AMP, for example, if you have any residue after selling, they will donate it to charity. Wesfarmers, Westpac, they pay it out. So I think you really just need to read T's and C's when you're setting up DRP.
Yeah, you do certainly need to. And we don't mean to call AMP out there, but their SEO is so good that was the first company we found.
Yes.
So that's one reason you wouldn't do it, because if you sell, you might leave some of your dividends on the table. You still will have paid tax on them when you got paid them. A couple of other reasons why people don't like to do it. A lack of control. You can't control the price that you pay, the timing of it, the size of it. It's just automatic. The concentration risk, like if you're constantly reinvesting dividends into big dividend paying stocks, that might become a bigger and bigger percentage of your portfolio when you don't want it to. One that I'm sure you're more attuned with than I am is tracking. You've said it can be annoying to keep track of.
Can be. I now find it super easy to keep track of because ShareSite does it on my behalf.
Not an ad, but go to sharesite.com.au/equitymates and you can sign up.
Yeah, definitely.
So there's some of the reasons why you might not do it. And then that leads to the biggest reason why you might not do it, which is what other opportunities are out there.
Yeah.
You're not getting the choice to invest that money in whatever you think the best opportunity is at that time.
Yeah, and that's what Tommy's kind of referring to when he says it might be a better idea to pull it out in cash, sit it in a cash account until you figure out the next best investment. There's two ways to look at that. It is that if you're really happy with the company or stock that you're invested in, then reinvesting into that, if your thesis still stands, is a great way to build wealth in that. But I guess with every lump of cash that you come into, you always need to question, is this the best thing that I can be doing with that right now? Yeah.
So we'll talk about how we do it personally and address some of those things. But just quickly, if you're interested in setting up your dividend reinvestment plan, the first thing to note is that in Australia right now, not everyone can participate because the way that it's mainly set up is you need a CHESS-sponsored brokerage account.
Yeah.
And then you set up your dividend reinvestment plan through the share registry, not through your broker. Important to stress.
It can be confusing if you're just starting out, but yeah.
Yeah. There's a world where the custodial accounts should just let you do it through your broker.
There is a world where that happens, but I don't know if technically, I don't know the ins and outs of it, but surely there's a button you can press in the future that says, give us, just reinvest it through the brokerage.
Yeah, exactly. Because then it's easier than then you cut the registry out of, then it's an extra step the investors don't need to do.
Just to clarify, it doesn't mean if you have a custodial account, you don't get the dividends. It's just paid in cash into your brokerage account. Bang. Yeah. And then you can either reinvest it yourself, you'll have to pay brokerage, or go and do something else with it.
Yes. So let's get to the crux of Tommy's question and answer it ourselves. He asked, wouldn't it be better to not have a DRP on and just claim the money yourself? What do you do?
So I personally don't do it at the moment, and that is because all of my stocks, bar a couple that don't actually pay dividends, are in a custodial account. So I can't. My hands are tied.
Would you if you could?
I would, yeah. The dividends at this stage are not significant enough for me to be like, I'm going to get 5,000 in dividends in one hit, and I'm going to then reinvest that back into a new opportunity. Until that happens, I'm okay for the ETFs that are paying dividends and the companies that are to just keep reinvesting back into it, because I'm still believe in those investments, and as I said, the size isn't huge.
Yeah.
So that's I believe it's a great way to build wealth. What about yourself?
I don't. I like the idea of having that cash coming into my brokerage account so I can rebalance if I want to. If the Australian ETF has done really well and the European one hasn't, then when those dividends come in, it just gives me the chance to say, where do I need to top up to keep my portfolio weightings pretty similar. But I think the most important thing to stress is that I don't have a propensity to pull that money out of my brokerage account and spend it. If I was so inclined, I would be turning dividend reinvestment plans on as much as possible, because it takes the human intervention out of it, and it just means I'm automating it.
If you're going to turn it off, make sure that the funds are being paid into your investment account, not into your funding account, i.e. your bank account, because that's where there's another added friction of you then needing to transfer from your bank back to your brokerage account.
Yeah.
So if you're not going to do it, please just make sure it's going straight into your brokerage account.
Either have a dividend reinvestment plan or have a plan to reinvest your dividends.
Nice. Well, that's a great spot to end, Tommy. I hope we've been able to answer your question. As I said at the top, if you have a question you'd like us to answer, head to equitymates.com/contact. All of the information is there. It's also a great place for you to submit your portfolio to Pimp My Portfolio, which is a great segment, because on the other side of this break, we're going to be doing a Pimp My Portfolio with Luke Laretive. We'll be right back.
This is Pimp My Portfolio. Pimp My Portfolio.
Okay, well, it is that time of the episode where we bring in an expert, we bring in a community member to get their portfolio pimped. And it is our pleasure to welcome Luke Laretive from Seneca to the studio. Luke, how are you?
Right. Alec, how are you, mate?
Luke, very excited for this.
And our community member today is Michael. Michael, how are you?
Very well, thank you, boys, for having me.
We are looking forward to this one. Thank you for submitting. I know it's not easy getting up in front of Luke, but I think this is going to be a good one.
Dorsey seems to be much nicer than me.
Yeah, you're building a bit of a reputation, Luke. But anyway, so as always, Ren, let's kick off with what's in Michael's portfolio.
Yeah, so Michael's portfolio is really anchored by some big ETF positions. Vanguard International shares just shy of half of the portfolio, and Vanguard Aussie shares just shy of a third of the portfolio. The next two largest positions are also ETFs, Vanguard International Small Cap and Vanguard Emerging Markets. Together, they're about 17% of the portfolio. Then the remainder is 5 individual stocks: BHP, QBE, South 32, Woodside, and Worley. So with that summary, Luke, where do you want to start with this one?
I think I'll just go and then Michael can chip in.
Okay, well, firstly, let's start with the name, and then perhaps we get Michael to let us know how he got to this point with the portfolio.
Cool. I think I know the answer to this, but I'm gonna call it pissing in the wind.
Luke, this is why people say Dawes is nicer than you.
No, not because there's anything wrong with it. More so just that 1% in BHP, 1% in QBE, less than 1% in 3 other stocks is pissing in the wind. Because actually, the core of the portfolio, the sort of 50% international, 50% Aussie type sort of vibe, I am totally down with. That's cool. Like, really good job, good idea. Obviously, being me, I'm going to be a proponent for active management.
All right, well, we'll get to that. Michael, before Luke goes too far down that rabbit hole, tell us a bit about the thinking behind the portfolio and how it came to be this way.
Yeah, so it starts with the single stocks, and those small positions can be explained. I bought these about 15 years ago when I was a student and didn't have too much to my name.
Yep.
I didn't really know what I was doing. I was getting some high dividend paying stocks and some pretty blue chip ones, trying to disperse them across some sectors. I really just kept them in the back pocket and not really thought much about them at all.
I thought that
I actually intend to. I actually intend to sell them in July, just to consolidate them into the ETFs. That brings us to the ETF positions. I was cash heavy after buying my home and offsetting a few years ago, and decided I needed to get started investing. So I looked at basically an evidence-based approach and decided that I wanted a broad market index approach, and I've chosen relatively low MER indexes, ETFs using Vanguard, and then tried to do that via market cap as broadly as possible. So I've gone obviously there with Aussie, international, emerging, and small cap.
Mm-hmm. Nice.
Pretty solid.
Yeah.
Pretty solid. Luke's a bit lost for words here, I think.
I'm never lost for words
true.
for us. So let's go into adding some value for you rather than just telling you how good you are.
But we should be clear that this is a great foundation.
Really good start, right? And I love, I love international shares over Australian shares as a general comment. If you're going to buy an ETF and you had to pick one thing to do, you can just buy the international shares and ignore Australia altogether. There's no reason you have to buy an Australian shares ETF for all the punters out there. So, because there are Australian shares in the international index. So, that's just by the by. Let's focus on the international small cap and the international emerging markets, and just touch on what you've done with the direct shares a little bit. So you don't need to buy, if people want exposure to resources, which is kind of where you've gone here, Michael, as a general comment, ex sort of QBE, you don't have to buy direct shares to have exposure to that. So a lot of people would have BHP or Rio or Woodside or whatever in their portfolio. You can use an ETF to do that, and that's like there's one called PIC, which is like the Global Metals and Mining ETF from iShares, and there's also one also from iShares I pulled up, which is IXC, the Global Energy ETF. So like a combo of those would sort of get you a broad-based energy and resources exposure. Obviously, I would prefer you picked an active manager. There's some good ones out there. There's the Argonaut Natural Resources Fund, the Perennial Strategic Natural Resources Fund. Their microcap's pretty good too, which are worth a look if you're interested. So that's sort of the resources side. From an Aussie small cap perspective, you don't have much exposure. So you've only got international shares, and we'll do that in a sec. But obviously, I'm going to promote the Seneca Australian Companies Fund.
Can I just jump in here because so Michael's got exposure to a index product for small caps. A couple of weeks ago, you answered a question in our email around is if you want small cap exposure, is the index approach the best way, or is it better to look for active management?
It's definitely better to look for active management.
So I think that's probably a good point to.
If you want to talk about like empirical evidence is like pretty important when you're doing investing, and I think Michael's touched on it in his approach already. But in smalls, and I can talk to Australian smalls in particular, the evidence says that you should use an active manager and you shouldn't buy the index. Now that's because of how the index is sort of developed, or how the stocks that go into the index are chosen. It's probably a long answer to go into on a Pimp My Portfolio episode, but I'd happy to do index construction and how the indexes work another day with you guys.
I'll give you a very simple, probably not as sophisticated answer. Small cap index has stocks that are small and growing, but they grow out of the index, and then it has stocks that were larger and shrinking, and
like
get,
disrupted.
essentially. And you get stocks that are kind of done or shrinking that then are the biggest parts of the index.
Correct. And further to that, on the bottom end, you get a lot of unprofitable, pre-revenue, hyped up, I'm going to throw brain chip under the bus, but pick another stock, type stocks that come in. Yeah, they're not massive weights, but they're still detracting from returns.
Yeah. So that's why having someone filter through the universe and try and find the gems there makes sense. Similar argument when it comes to emerging markets. A lot of emerging markets indexes are quite old financials and resource heavy. You don't get that like up and coming consumer growth story that people want from emerging markets.
I think also on emerging markets, it's a part of the world, you know, you're investing in parts of the world where accounting standards aren't the same as they are in Australia or the US. Legal frameworks and regulatory frameworks aren't the same as what they are in markets that you're familiar with where you've been investing. And it does take a nuanced understanding of the cultural, geopolitical environment in those regions to be able to effectively analyse a company and then effectively weight that company in a portfolio. So I think that emerging markets, Aussie smalls, and probably to a lesser extent international smalls are great places to employ active managers.
Michael, had you said at the top you've obviously chosen the Vanguards for their low management ratio, which is certainly fair, but had you considered active for those parts of the portfolio that Luke's talking about?
I think at the time I bought them, I didn't have that information that you've just shared, but I have learned subsequently that active management can be either similar or more effective for emerging markets and small caps. I didn't have any hard data about exactly how they line up, and I was happy to punt instead on the low MER of an index approach.
Fair call.
when making a decision.
Yes.
Yeah, I think that, you know, it's hard to pay for something that you don't know, or you don't know what to do, so you just go like the cheapest one. Is kind of always, seems to be a pretty logical approach. It's not necessarily the best approach, and I think, Michael, it would be worth investigating, I suppose, or having a chat to me or somebody else about that, because definitely in Aussie smalls, there's lots of good managers. There's lots of pretty average managers, to be fair, and certainly there's plenty of alpha there for people to go and chase. International smalls, I think it's a harder market. You can concentrate your portfolio in such a way that you can benefit from a lot of the value in smalls around the world without owning everything. So a lot of managers do well in that sector. I know you guys love Nick from Fairlight, but he's a mate, so I'm a big fan of what he does as well. But if you didn't want to use an active and pay Nick, you could pay Van Eck instead. Their MER is not cheap, but they've got a quality international smalls ETF.
Oh, there you go.
It's a good product.
Do you have any final questions for Luke there, Michael?
I guess on just that topic of emerging and small cap, does time frame change how you would make a decision regarding index versus active? If my intention is to keep these indefinitely, perhaps forever, does the index approach, is that more likely to be a more safe, long-term, good quality performing approach, and does an active approach is that prone to perhaps less consistency of performance over a longer period of time?
No. You can categorically say no. It depends on your skill. It's like two people hitting a tennis ball. If I'm hitting a tennis ball and Roger Federer is hitting a tennis ball, what's the chances of it going in? Well, it depends on how good you are at tennis. So it's the same sort of thing here. You're picking a manager or you're not picking a manager. The result is the same. One requires no skill and you're not paying a lot of fees. The other one, you could choose a bad manager and make the wrong decision. So I understand why you sort of go the fence sitting, for lack of a better word, option. But certainly they're no safer or less safe. And in my view, there's opportunity for active managers to not only outperform, which everyone sort of bangs on about, generate the best possible returns, but generate the best possible risk-adjusted returns. So, for the risks they take, do they get asymmetrically paid, and taking a more nuanced approach to selecting and combining managers. So that's kind of what we do at Seneca. That's what we're kind of good at. And it's definitely doable. And it's definitely lower risk if you do it properly than just owning everything.
I think the point is, though, unlike an index where you can leave it in the bottom drawer, you still have to pay attention to if you select an active manager, you still have to pay attention to how they perform year on year on year.
You can set up a passive strategy And like you said, once you've got your asset allocation set, the only job is really just rebalancing. I think if at all, if you choose a multi-asset, you don't even need to do that. If you're running active managers or direct shares, then obviously you're taking a much deeper interest in what you're doing. And if you're not paying somebody to do that for you, that can be a lot of work. And I'd argue too much work for someone who works full time and has other interests in life. Hence why I have a job. But, each their own.
Nice. Well, a few things there for you to think about, Michael. Definitely on the active management side, and something that we speak about on the show is how we get exposure to small caps particularly, and that toss up between international and how to choose a manager. But Luke has done a lot of research on choosing fund managers and has a pretty extensive database. So if you do want more info, we can connect you with Luke for sure. But thank you so much for coming on today. We do really appreciate you submitting. And I hope you got something out of the convo.
I did. Thank you, Equity Mates, and thank you, Luke.
My pleasure, Michael.
Thanks, Michael.
Equity Minds.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.